Hi, this is Randy Finney with the Right Side of the Chart, and this is a mid-morning update for Thursday, May 23rd, 2019. I wanted to get this video out sort of an odd time. Just markets are moving, and when there's volatility, I know there's a lot of questions, and I try to do updates as frequent as possible. Please be patient on the chart request, questions in the trading room. Remember, I spend the bulk of my day reviewing charts, continually looking for new setups, monitoring existing trades, managing, over a dozen personal family accounts, and then, of course, answering questions on the site, trying to give priority to any issues people might have logging in and stuff like that. So, I'll get back to questions as soon as possible. If I say I will and I don't follow up by the end of the day, just bump me. That you can use the contact form at that point. Send me an email. All right, let's dive into the charts. I want to start out here instead of the markets as I usually start out with. We'll get to those. Start out with USO because I think I go over the charts day in day out, the same levels. Well, I should say levels change, and so that's why I do these daily updates. Sometimes there's new levels, new developments, but what I wanted to kind of harp on here a little bit is just the benefit, and hopefully this will help some traders of having a trading plan and sticking with the trading plan unless something compelling changes in the charts. And I say this now because when volatility spikes, and that's what happens during a correction, stocks tend to fall, and securities, in this case oil, they tend to fall a lot faster than they rise. And what happens when you get these oversold conditions, sharp moves down, the kickback rallies are pretty impressive too, and that makes a lot of traders second guess their positions. So most importantly, have a trading plan. What you're going to buy, where you're going to buy it, why are you buying it, where do you plan to exit that trade if you're right, and where do you plan to exit if you're wrong. And I'm using this example because we shorted USO 3 weeks ago, almost a little over 3 weeks ago on April 30th, right here on the back test of this trend line. And as I talked about here, there was a little stall in the middle of the trade. Now, the trade never went underwater. We remained profitable the whole time, but after hitting the first target, making it about halfway to what at the time was a second target, there was tensions in the Middle East, and that put a bid under oil. But I made clear both in the trading room and in several updates on the front page and videos and everything else that nothing compelling had changed in the charts, so I was not going to modify this trading plan. There are occasions where I'll change the targets on a trade, close a trade out early if there's enough compelling reason. And although this trading range was a little frustrating, it's still only 3 weeks, just over 3 weeks we hit the target. But again, the takeaway was, and I listed a couple bounce targets. This was one right here, 1318. I've already cleaned up this chart, and said, that's where any rallies were likely to be capped, and that's what happened. So again, it's just an example of define your time frame, define your trade. Some traders might have taken profits when T1 was hit for a very quick, relatively small gain. Others might have held out. Well, T2 and T3 were both hit today, and but again, that's the point, and it comes into play too with these equity index shorts. In fact, I need to look. I'm going to revisit adding SOXX back, and in some other trades. I've been keeping the trades relatively light, but hyper focused on the ones that we do have. And I'll do that sometimes in a broad-based sell-off. You can sit there and try to handpick stocks, and certainly if you do that enough, there's a good chance you'll outperform the markets even to the downside. But in a broad-based sell-off, what's nice about that is everything gets sold, and you can profit pretty easily on QQQ or SOXX, the sector and index ETFs. And you're broadly diversified. You don't have to worry about an earnings gap or a particular company news coming out on a certain company and having a big gap against your position. So we'll focus on that. USO, again, just an example of sticking with a trading plan and played out in a flash. And that's what tends to happen during corrective phases, especially, and I talk about this a lot, during periods of consolidation. This is a very clear, well-defined consolidation range in that box. And when you get these periods of consolidation, they're pretty powerful. Certainly could have broke the other way, but it didn't. And when it broke down, what that did is this breakdown today. Futures traders could have caught a CL short. In fact, CL was mentioned recently right here at this divergent high as a short. But what happens is ETN traders, they were denied. The shorts were denied an objective entry because we gapped down here, very large gap, and then we kept going from there. And the other thing it does too is it traps longs. Longs who were bullish because of tensions in Middle East, or bullish for whatever their reasons were, they were, especially trading the ETNs, they were trapped. And when they gap down, they probably, there's probably a lot of praying and hoping, kick back, maybe a backfill the gap, and I can get out. No, this is what the markets do, and they can do this in the stock market as well. So I guess the point I'm trying to make, spend a lot of time on this trade, is when you have a trading plan, whether it's QQQ or an individual stock, if it's a solid plan that you went in for a particular reason and nothing very compelling has changed, again, if something compelling in the charts changes, it convinces me enough, hey, this trade, whether it's profitable at that point or not profitable but not yet stopped out, if there's a good chance that I see enough in the charts to say, you know what, I don't think it's going to hit my target, I think it's going to reverse, then I'll modify my trading plan. But otherwise, I find it best to stick with it, ride out the zigs and the zags, and I think that's one of the keys to trading, in my opinion. Okay, and on that USO trade, that was the final trade. The final trade is often, not always, but often a level where I expect a significant reaction or reversal against the trend that I was positioned for. In this case, I can tell you that's the case with USO. This is and crude oil, I'll get to in a second. Nice support level, especially these reactions here that I'm highlighting. Reactions from below, broke out above that level, came and back tested it. So that $12 level, it says 1206 on the line, we're 1208 now. That's a level where, although we could certainly break it, like I always say, support is support until unless broken. If it breaks, you can see my next target or level is down here, and I think there's a good chance we'll get there before all is said and done. But we could have a snapback rally. The odds are elevated right now for that, and I think a natural target, I think a lot of eyes would be on it, would be a backfill of that gap. But again, this is a case of sometimes you have the tail wagging the dog, where the ETNs will lead the commodity. Let's take a look at the commodity itself. Crude futures, I think there's a lot of professionals and institutions in there, and let's take a look at those charts. All right, this is my CL daily chart. So we have daily candles here, and there's a pretty decent level right about, give or take, about 58.40, and those are the same reactions that I just showed you on USO. Remember, USO, as all commodity ETNs, they track, or ETFs, but in this case it's ETN, they track the underlying commodity. Now, if that level goes, I will say this is an even better support level. This is an area I would be interested in maybe adding USO as a swing long, where personally, I may try to game a bounce trade here. This is a level where I may add it as an official trade if we get there and if the charts confirm at the time. Not just solely for the fact that we fall into support. That's not always a reason to go long. Sometimes stocks move down to support, and instead of looking at that as a level to go long, I'll look at that as a level to hold off and wait to short on a break of that level. So that's the key to trading. By proper technical analysis, you identify the support and resistance levels, trend lines. Then, based on what you see in the charts, you decide whether you're going to expect a breakout above that level or a reaction off it. And that's what we're looking at here. So those are the levels to watch for crude traders or CL traders. Okay, and this is the 60-minute chart. So you can see that this sometimes it only takes, especially when the primary trend, remember the whole basis for this trade was the longer term, what happened on the daily charts, breakdowns there. And so what you had is a little snapback rally. There's that trading range I showed you a minute ago on USO. Kind of a little sloppy here, but a little, at least on futures, we broke above it. But just 3 days ago, on Monday, I think it was, I pointed out this divergent high right here, showed a scenario would come down to this trend line. We went down and we smashed right through it. You can see futures. We passed, went right down through it and continued to melt down. But now, as you can see here, if I put a line, there's some pretty decent support here. That doesn't mean we have to hold, but I'll be very clear and not mix words. The risk reward rapidly diminishes for remaining short, especially for adding new shorts at this point. So that doesn't mean that it can't go down anymore. It just means the risk reward's not favorable. Yes, it's overshot that 58, 55 level right now. So as of now, if you are short, you can continue trailing stops down. But if it can recover that, especially today, a quick snap back above there, we could be looking at a rally. However, and we're going to get to the broad markets here in a second, the markets are still in a very precarious technical posture. The bearish case I've been making for months now has only continued to firm up each and every day, including today. So therefore, there's no change in my longer term outlook. I'm not even probably going to spend much time on that. Just to say that if the broad markets enter a next, we've consolidated here for the last couple weeks. If we break down and have the next major wave down in selling, another impulsive wave down in the equity markets, that is most likely going to spill over to crude. Crude in the stock market have been an extremely highly correlated trade for many months now, going back well into 2018, and therefore that correlation, whether it's the same traders that were long equities and long crude, now are getting forced margin calls, or that maybe they had nothing to do with each other, but for whatever reason that correlation has existed. So I just wanted to point that out. If the stock market comes under very heavy selling, almost everything gets liquidated except risk-off assets. So I guess the point is, don't try to get cute on a bounce with crude. If you want to take it at any point, sure, like anything else, just don't get married to it. Put a stop in if you get stopped out. But as of now, stock market, let's get to that, and then I'll let you make your own mind up what you want to do on crude. But I close the official trade out. That's over. Again, the risk reward is just not favorable. And if you're in it, like I said, sometimes what you can do, especially if the market's going to melt down, if you didn't take profits on your USO or CL, just set a stop and let it run. You might, sometimes you get those big moves down where oversold can become a lot more oversold, and that's always a possibility. So you can allow, TA 10 or trading 101. Cut your losers and let your winners run. So it's up to you whether you want to book profits or at least, very least tighten a stop at this point. Okay, on over to the equity markets. I'm on the futures charts. Remember the big levels that, or one of the big levels I'm watching are the recent lows from what was it, May 13th or so right here, and that was price target and still is, but we've already hit it once. Now, one of two things is likely to happen here. This could be a test, as you guys know, unless you're brand new to trading or technical analysis. Very often during a correction, you come in and test those lows. You come in for a second test, and you're either going to test to the button, but chances are you're going to reverse a little shy if everybody is wanting to buy. So really, there's an invisible thing we don't see here, and it's just the makeup of buyers and sellers in the market right now. We don't know right now, are there more willing buyers, more people that want to step in and buy Apple, Facebook, Amazon, buy the markets right now? If so, that level holds. I don't think it's there. Based on what I'm seeing, I think there's more downside. I think that level will go. But even if it holds, sometimes you slightly undercut it, so you need to watch for that too. Now you can short a break, but if they ramp it up quick, get back above there. And let me be pretty clear right now too. During periods of high volatility, I find you have to use wide stops. If you're running tight stops in a market like this, they're going to take you out. See these zigs and zags? That's just, the stops just get blown out. So again, it comes back to that trading plan. I'm talking about micro levels right here, but if you go back to QQQ and SOXX, those trades that we've had, and you're looking at the daily chart and you're swinging for the big picture, that as I said, a triple or home run or even a grand slam. This is all noise at this point. We've shorted way back up here, and there were plenty of bounce ops like this one right here to the downtrend line. So if you have a comfortable profits right now and a nice entry, if you allow for a pretty wide stop and allow them to maybe make another run back at that level, back at that trend line, that may open the door for a much bigger move down here. And as you can see, I've got a couple levels here, minor level about 71.80, but I think if we can break those lows with conviction and the floodgates open up, I think there's a good chance for that. We're looking at least for the next thrust down. And there may be more than that in the coming weeks to months, but at least that would take us down. Let me try to measure it out here for you. Darn it, move my line. Let me just keep that line out of the way. To measure with a trend line here, about 6% drop down, little over 6% down to that level, about 68.60 if that's hit. So let me get rid of that, put that one back where it was, right about there. There you go. So those are the levels to watch, and I don't see, well, I should point this out because I need to point this out. Absolutely. There is potential divergence now forming here on the PPO. RSI is about equal lows, but there's still a chance for divergent low right there. So that's the scenario we have to be careful for here if you're short. A flush down move, or if you're long. Look, if you're bullish and long and you're looking to levels to go, watch that level. Anywhere from about where we're at now down to about 71.80. If we can reverse, we have potential here for bullish divergence on the 60-minute chart, and that can set up for a pretty powerful move. This looks like a big falling wedge right here from here, this downtrend line and the divergence line. So to see something like this and breakout, that could actually propel the market to new highs. The potential is certainly there. So I'm going to lay that scenario out. We'll continue to monitor it. As of now, price action, daily charts, a lot of technical damage on the daily and weekly. I'm not favoring that, but I'm most certainly open to it, and will most certainly not ride out my short positions. You know, if this scenario develops at some point, I'll have scaled all the way out of those, maybe even gone long. Next up, ES, and I'll get to SPY and QQQ for you guys in a second. I know quite a few of you trade ETFs. Here we go. Same story. This is a big descending megaphone pattern. Offering multiple short ops, and a clear downtrend so far. Now we have to keep the downtrend intact. We need to undercut this previous low, because a downtrend is simply defined as a security making a series of lower highs and lower lows. So the next low, if we take out 27.93 or so, that support level, that would keep that downtrend intact and open the door up for a move down here to my next target, about 27.29. We did take undercut on both NQ, which I was on a minute ago, and now ES here. We took out these minor trend lines last night, and that triggered the selling today. ES also popped below that 29.30 level. It's trading a little bit below it now, not too far, but it's at 28.23, and again I have that support at 28.30, minor support we'll call it. There is also potential divergence forming here. RSI about making an equal low. If I can grab that trend line, could be tricky with this platform. There we go. So potential, well, that RSI divergence would probably be burned through, but not the PPO divergence. So just something to point out. Again, it's the development we'll continue to monitor if it plays out. And ideally, obviously, this trend line, the more reactions that you have on it, the more significant it becomes. So that's the other thing you want to watch for a break of the uptrend line right here, and there it is. So far, we're below it. Bigger picture, let me just loop back to that, because that's usually where I start. Bigger picture is this. The market is between a rock and a hard place. The rock being, whichever one you want to call it, about 279, 280 right there on the downside, the recent lows, and then the recent highs right here, that reaction high about 289. SPY did break down. Remember, I talked about this, and this also helps give us a little check mark for the bearish case. I talked about this symmetrical triangle. Could break either way. Well, it broke to the downside, and it did it with class, style. That's what you want to see if you're short. Again, it traps a lot of longs in, denies shorts entry. And when I always say that, why is it good if it denies shorts entry? I like to be the only short. In a perfect world, on a security, a trade, I'd be the only short in it. The more shorts you have in a stock or an index, the higher the potential for a snapback rally, a short covering rally. Because as I always say, there's only one person or one type of person in the financial markets that are a guaranteed buyer of a stock. These guys can come on CNBC and sing the bullish song all day long on a stock or the index, but guess what? They don't have to buy it. If something comes up, they see a better opportunity, or they second guess, they may be cheering up the market, but they're not long, or maybe they are long. However, they don't have to buy. A short has to buy. If you short a stock, you must buy to cover to close that position. What happens with stocks or the index or the markets when short interest gets to a certain level, it's too high. You have all those shorts that start to take profits on the pullbacks or the drops down to support. And if the market suddenly reverses and Trump tweets something out and the market starts going up, they panic and they cover and you get a short squeeze. So that's why I often talk about shorts being denied an objective entry. I kind of like to see those things. Obviously, if I'm already into the position ahead of time. And let's not forget QQQ. QQQ broke from its triangle and boom, right down to that 178 level. In fact, let's look at the low today. Low of 177.95. Close enough for government work. A little frustrating here. As I mentioned, I've had quite a few updates on the official short trade for QQQ. We hit that back here in the pre-market session when the market bottomed back here. We hit and exceeded that target. So I'm going to leave it there, and I'm also going to say that I think if it breaks, if we hit that target, there's a good chance we're going a lot lower. If I can get out, I'll study the charts. I may add some additional trades, extend this current trade. If not, it's up to you. If it gets hit, you want to. I can tell you this on crude, I feel a little better about jumping out. On this one, I can tell you personally, I'm going to stick with it until I see a reason to get out of this trade. So, if T3 is hit, if and when, I'll lower the stop down at the very least. Excuse me, or I'll have to add an additional target first. I never add targets after the fact. If a final target's hit, then that's hit. I'm not going to add a target afterwards, but if I can get this out in time, I may extend some targets here, and that may or may not be the the next target there. So like I said, maybe a good time to trail stops down and let this one ride. That's kind of been my game plan all along, both personally and initially with this trade. So whether or not I add a target now, I can tell you I think there's probably a lot more downside coming in the coming weeks to months here. And for those that happen to miss it, if things get really ugly, target, and I'd put a decent chance on it. We'll see what happens, but I'm looking at a drop all the way down here in both SPY and QQQ to come in back, test these highs back here from 2015, and we broke out in 2016. And that's the grand slam right there. 36% downside, 37% from where we're at too. Not even where we entered the trade. We entered above where we're currently at. Whereas I believe the consensus is, a few weeks ago, the vast consensus was we're going a lot higher, that this couldn't possibly be a bear market rally and was too strong, and therefore the year we'd have to end up positive, make higher highs. That to me was clearly the consensus a few weeks ago. I really don't, turn the TV on. I'll read I get most of my news through written articles, but I would assume now that every time there's a correction, you start to get those that were bullish swap to bearish, and I'm guessing that you're going to hear talks about a test of the lows. You heard it quite a bit here, and I think halfway up the rally towards the top, everybody, the majority, I should say, gave up on that. Now, while a test of those lows, give or take, is certainly a possibility. And at this point, again, we could be getting ahead of ourselves. I don't want to. I'm just trying to lay out this long-term scenario in case things start to develop pretty fast, unwind, because I've seen that before. In corrective phases, you can all of a sudden just hit a waterfall sell-off, and if I get these potential targets out to you in advance, then and you decide to hold out for them, then you know what to do before I can get an update out there. So that's why I'll touch on the longer term. So whereas that's where I would say the majority of those that are still bearish, I think we can go down that lot far calling for. I think we'll continue on down through there, as I've said, and come on down here. Ultimately, it's not going to be a straight shot down, but that's where I see us heading. And if it happens, I think it's going to happen this year. So that only gives us another just over 6 months. So we'll see. Okay, and so just for those of you who are bullish and think that's complete heresy for me calling, for a drop as much as another 36% where we're at, well, let me say it's not over at all, not even close. I just showed you that bullish wedge scenario on the futures. And as I've said many times over, support is support until unless broken. 178 is just a natural pullback target. It looks to be about the measured target, a little bit more for the wedge. So, if I was of the mindset the market's going to new highs in 2019, I really have a very hard time to figure out why somebody wouldn't be buying aggressively right here, because this would be a great buying opportunity. Pull back to a very well-defined support, key level on SPY as well. And again, you don't get married to it. You set your stops, appropriate stops in place below, or maybe at the very least, if you were bullish here and looking for a pullback and you haven't been scaling in all the way down yet, start scaling in here. It's, again, not what I'm doing, but I certainly would be it's what I would be doing if I thought the markets were had considerable more upside in 2019. So there's SPY. Again, all the stuff I've already covered. SPY had a double top failure, came up, failed at the 2018 highs, moving down so far, but that big 281-ish level, remember we had the 3 reaction highs there, danced on it for weeks back here, finally broke out, and then we're back testing. Again, that's why this is a key level. And if the markets hold up here, we could be heading to new highs. It might not be a straight ride up. Who knows? I don't know how that would play out. We might have to consolidate for a while before we break out. A lot can happen, but as of now, I'm kind of still leaning this way, downside. And I showed you QQQ a second ago, right above that third target, which is set up just above support. SPY is also at support here, pretty decent support, about 282. You can see it here on the 60-minute chart. See the reactions here to the left. So that's where we're at, and I'll just keep it very simple. I favor downside resolution from here, whether we bounce first or not. I'm also leaning towards any bounce being very fleeting and not going very far, just based on what happened with that gap down today. That would be the ideal scenario. But if we do bounce, there's that downtrend line. That's your first. That's the most significant level overhead, is that downtrend line. And then we still have these other levels, which were my bounce targets before. So this is what I favor. And again, you want to see it pretty much at this point. Just see if they take out today's lows. We already ran down, undershot that level briefly. We've had a little bounce off there so far. So a break of today's lows should usher in some more selling and hopefully do the trick and get us down here to that next target there, about 277.75 on SPY. I was going to wrap it up there because I want to keep this video under 30 minutes, but I'll just hit on SOX because again, this has been pounding the bearish drums on this one. Close the final trade out when we hit that third target. I didn't get around to extending any targets, and that's fine, and I may re-enter this. It's now clearly broken below that 189.51 support now on the weekly chart there, and next support I have it down here. And again, this is a weekly chart, is 170, but this thing has just now put in, just recently coming off a giant divergent high, bearish PPO crossover, everything I like to see. I think there's more downside to come. Counter trend rallies are impressive in the semis. This is a volatile sector, so again, it's kind of define your trading plan, define where you think the semis are going. I think ultimately down here at about 102 on SOX, you're talking about another 40, 43, 45% drop. And to do that, the only way to successfully swing it, unless if you're an active trader, you can game the rips and the dips and the bounces off levels. But other than that, you need to use a wide stop. And to do that, you need to take a reasonable position size, especially if you're going to use a 3-time leverage SOXX. Remember, there's a position size calculator on the site. Click on that little calculator icon in the top menu, and then put in your position, your targets, your stops, and it will quantify for you in dollar terms not only your profit. Don't focus on that profit. You need to pay attention to it for your risk-reward ratio, but look at that loss and look at it in dollar terms and say, how am I going to feel if I lose X amount? And then just play with the position. Temper it down. Keep a small enough position size that loss isn't going to make you, even as you start to approach that stop loss, make you second guess the position. So I think that's where a lot of traders get into trouble, is just not paying attention to the size of their position or the leverage factor involved if they're trading a 3-time leverage ETF or the futures or anything like that. So there's SOX. I don't think I have anything else important on the daily. It's just in free fall right now. Sure, like I said, there's some resistance coming up, but I certainly don't see a reason to step in here and go long the semis at this point in time. Intel's coming up on that support I showed you about before, 43. In fact, it kissed it today. Still has the divergence on the 60-minute chart. So of all, if you wanted a paired trade, let's say you go, if you're short SOXX or SOX, one of the two, and in the semi ETFs or any of them, this is the best of the lot, in my opinion, where you could go have a long position in Intel as a hedge against a short of the semiconductor sectors. It's not a pure play short because you're only one of many stocks in the ETFs, but again, one that I think at this point has minimal downside because it started its correction early and has already fallen extremely oversold to a pretty decent support level. So that's Intel. All right, we're going to wrap it up here. This has been Randy Finney with Right Side of the Chart.